These three Fidelity funds are the reason I crossed the $1 million mark. No day trading, no chasing hypes, just consistency and patience. In this video, I'll show you the three funds that I invested in, explain their historical performance, why their fees and track records matter, and show you exactly what would have happened if you would have invested $10,000 into these funds 10 years ago. By the end, you'll hopefully see why long-term investing in the right funds is the real millionaire hack. Just a disclaimer before we dive in, just a quick note. This video is for entertainment and educational purposes only. I'm only sharing what I personally invested in. This isn't financial advice. Always do your own homework before making any investment decisions. Now that that's out of the way, let's get into the funds that I invested in. First, there's FXAIX, the S&P 500 index fund. This is the classic set it and forget it choice. It tracks the 500 biggest US companies across all sectors, whether it's tech, healthcare, finance, you name it. This fund is steady and a low cost with a 10-year return of roughly around 15% annual and an expense ratio of just 0.015%. Now, if you would have invested $10,000 10 years ago, your portfolio would now be, without fees, around $40,455. After fees, roughly $40,402. And your total cost of fees would be around $52, which is practically nothing. It's the slow and steady fund, low risk, low fees, and you can pretty much sleep easy holding it pretty much long term. Next, we've got FNCMX, the NASDAQ index fund. This one's tracking the NASDAQ, which is mostly tech giants like Apple, Microsoft, and Amazon, along with thousands of other companies. It has roughly around 28 to 2,800 companies at any given moment. But the top 10 make up more than half the fund. Over the past 10 years, it averaged 17% annually with an expense ratio of 0.29%. So if you would have invested $10,000 into this fund 10 years ago, your portfolio without fees would be worth about a little over $48,000 and after fees roughly around $46,890 or so. This would bring the total cost of the fees to between $1,100 to $1,200. Now, this is not as low as the previous fund, but you still have great returns without the stress of having to pick your own stocks. Lastly, we have FSELX. This one's a little different. It's an actively managed mutual fund, which means there's a team picking stocks instead of just tracking an index. The goal here is to beat the market, which can work really well, but it also comes with a lot more risk than an index fund. This fund focuses on the semiconductor companies with big names like NVIDIA. There are roughly around 40 companies in total, but most of the fund is concentrated in the top 10. With that contributing roughly 80% of the portfolio. So it can be a roller coaster if one of these companies has a rough year. Here's the numbers. Over the past 10 years, it averaged 29% annually with an expense ratio of 0.62%. Let's say you invested $10,000 10 years ago and left it alone. Without fees, it would have grown to about $127,000. After fees, roughly $121,000. So the cost of fees would have been roughly $6,000. Now, even though you paid significantly more in fees, it still absolutely crushed the other funds. And that's exactly why I didn't let slightly higher fees scare me. Now, before you invest in any kind of fund, I want you to remember two important metrics. First is the expense ratio. This is basically the annual fee the fund charges. Now, tiny differences might seem like a big deal, or they might not seem like a big deal, depending on who you are. But over time, they compound, and they can add up to tens of thousands of dollars. But don't avoid certain funds because of a slightly higher expense ratio. For example, FXAIX charges 0.015%, and FSELX charges 0.62%. However, sometimes a trade-off of a higher expense ratio is worth it if it historically has provided a higher rate of return, which is the case with FSELX. The second is track record. Always go for an index fund that has at least a 5-year track record, preferably 10 years. New funds with 1-year or 3-year returns can be very misleading. They might be hot right now, but you want consistency. not hype. Always make sure the fund has proven itself over time before committing your own hard-earned money. All right, before we wrap up, let's talk about the magic of compounding, or what I like to call the continuation effect. The longer your money stays invested, the more it grows, not just from the initial investment, but from the growth building on itself. That's why even small investments like $100 a month or even $50 a month can turn into serious wealth over time. The key takeaway from today: do your homework. Look at the fund's track record, understand the fees, and don't let small differences in expense ratios scare you off. Sometimes paying a little more gets you way bigger returns. And remember, consistency beats hype. So if you found this video helpful, hit like and subscribe and drop a comment telling me which of these funds you'd be interested in investing in if you had $10,000 to invest today. Trust me, your future self will thank you for starting now. I'm glad you're here.